Welcome back, ladies and gentlemen, for another YouTube video. All in Crypto here, and this is going to be our daily cryptocurrency market update where we express our thoughts on the cryptocurrency space every single day. At the moment, we've been doing a lot of looking at the kind of macroeconomic situation, which is a bleak one. And saying that sounds rather contradictory given the fact that we are seeing the stock market, the crypto market, even the commodity market in regards to the likes of gold and silver, or I should say the precious metal market, catching a bid in this kind of what I'm deeming a bleak time or a not so fruitful time for markets across the board. And we're going to address that in this video because the real question is this just a relief rally or is this the new bull run? And it's my opinion, and I could be wrong, guys, time will tell at the end of the day, that this is just a relief rally and ultimately the cryptocurrency market still has lower down to go. I do not believe that Bitcoin or the cryptocurrency industry has ever had to face the kind of economical shitstorm that we are now in. We are in a recession, whether the White House want to redefine it or not. And we've never had to kind of go through that kind of a period. And we've spoken about this multiple times on the channel. We've shown you that if you go and look at the NASDAQ, go and look at the S&P and what happens, you know, we always bounce off the 200 weekly moving average before then coming lower. And that's what we're going to talk about in this video. We're going to be talking about a little bit about what's going on. You know, there is, even though I believe this is a relief rally, there is still definitely the scope for upside. You've got this kind of pocket of hot air above you, taking you, you know, sort of back to your 28, 29K range if you can reclaim it. The issue is this rally could get killed off really at any point, in my opinion. And this is very much and has all the hallmarks of a relief rally. What I really want to do, and we can do this to kick things off, is I recently did another interview. You guys know that Francis Hunt is a regular guest of this show, a good friend of this show. And I recently did an interview with him, which is an hour and 11 minutes long. Now, I'm going to release this maybe tomorrow, maybe on Monday. For you guys, my Patreon members are going to get it today. But I want to just play you this clip because the narrative and why one reason markets are rallying, we spoke about this in yesterday's video, is because they're kind of going, okay, we've had peak hawkishness. The problem is people are acting like QE is already taking place. You know, markets are forward looking. That's very apparent. When you're looking at the price of an asset, you're not looking at what it's really priced at today, more what it's going to be worth in the future. When you invest in something, you're investing on it based on whether you think it's going to be worth more in the future or worth less. Markets, derivatives, very, very similar. But the issue that people have got is, okay, they're going, okay, well, we're probably not going to get another 9.1 print on the CPI. It's going to be lower. Probably not going to get another 75 basis point rate hike. But the damage that's already done, the Fed are at neutral now. When they go over neutral, which they will be doing in the next interest rate hike, that's when things start to get sticky. And it wasn't, you know, the last time we were at 2.5% Fed fund rate, you know, the repo market literally stopped working. So I'm going to play this clip and then we're going to get into a number of things surrounding it. I've not heard anybody talk about the points that Francis raises in this video. So pay attention, guys. And of course, I'll release this video either tomorrow night or Monday night for you guys to watch the full interview.
This best summarizes my take on answering exactly that question. In other words, do we have more vicious downside to come? And I'm going to share something that shows the unemployment rate. So permission me there, if you will, on the share screen. Thank you. So there's two lines on here. There's a lot of annotations that I've added. So I just want people to focus on the squiggly lines. There's a white one and there's a yellow one. The white one is the New York Stock Exchange Composite Index. So it's not quite the Dow, the Dow's 30 equities. This is everything. And so you're starting bottom left on the white and you've gone kind of to the top right. And then the other line that I just want you to focus on, and then I'll explain my annotations in a second because it's kind of busy and I need to introduce this layer by layer. The other line, the yellow line, is the unemployment rate. So unemployment, that's pretty hard stats. If people are claiming unemployment, it means they don't have a job generally. So what you'll notice is, if I draw with you here, and I'll choose the TG pink and I'll go fat Koki, the low of the unemployment rate roughly over here. There we go. You see me doubling up on it over there. The low on the unemployment rate was pretty much where this green arrow, the high on the equity market. The white line. When the unemployment rate shot up to there and reached a peak and then sort of based for a while and only began to come down from around this point, you are at the lows of the equity market down here where the pink arrow is. So the pink arrows are all the lows of the equity market. So once you had your spike high, but you stayed stubbornly high, and then you properly, the last point before you started to come concertedly down, you came in, that was your bottom of your equity low. So again, if we go again, when was the point that the unemployment rate, that was the absolute low, but this was the final low period before it began a run up. When that happened, the final low period before it began a run up, that was your high of the stock market, 2007. You see it there on the green arrow. Roughly the last low levels before it's had a major move up. When you hit the high on the blues, the blue marks are all the highs of the unemployment. You're essentially at the low point of the stock market. It's not a surprise that these things are correlated, but the highest points of unemployment are going to be correlated to the lows of the stock market, and the lowest points of unemployment are often going to be correlated to the highest points of the stock market. So from there, we had this huge 2009, and we went into a mega reflationary environment. This was QE1, 2, 3, super low interest rates. Unemployment went to an exceptionally...
And just bearing in mind, Bitcoin was born in this period, right? So it's never had to face the adverse of this.
Low. Bear in mind, participation rate is ridiculously poor now at the moment. But inside of that which they count within unemployment, we went on the basis that you're comparing like for like to an all-time low in unemployment. You'd never had it so good. I would argue a lot of those jobs, as I say, will be the menial zero contract stuff. But nonetheless, everyone had worked 2019. The final low before you started to go up again was actually here. That was the absolute low. But the final low before you started to go up again was here. And you went up in a straight line on account of it being the events of the pandemic. That was your final high as well. End of 2019. By the time the 2020 first quarter started, we were full lockdown and the whole story. Major crash, that's your low of the stock market. That would have occurred at the peak. Now, this yellow line's actually gone off the roof here, just to put some context in here. So again, their actions and their counter actions, if I just clip the highs, this is somewhere off there, and then the lows, you can see this is actually what we call a broadening structure. Their actions and subsequent reactions to events they created are creating ever greater volatility. They are not a stabilizing force. They are a volatility enhancing force, which each shake and pump and dump scalps the retail punter and stacks the chips into the house. So when you understand this, you get a feeling. Now, to take it forward to where we are now, because everybody goes, yeah, nice retro look back at 2007, etc. What does it mean for us today? So what does it mean for us today? Well, where are we today? You've just had another all-time low, 2022, in the unemployment rate, and you've started up. You're beginning that journey up, but you are still very low. This entire range for the unemployment, you actually weren't that low in the 2000s. 2006 was your lowest. It was up top here. And you weren't that low even in the year 2000. So 2002, you've never been that good, let's call it, in terms of unemployment, but you've never spiked so goddamn high in the unemployed. Now, my argument is the next events that will befall us will have to match.
And I'll leave it there, guys. You guys are going to have to wait till Sunday or Monday night to find out exactly what the rest of that interview entails. You know, that was a very short clip, around about 6 minutes or so. It's an over an hour long interview with absolute pearls of wisdom in. But essentially, what Francis is highlighting there is that there's a huge correlation between unemployment at lows, at stock market at highs, and an inverse correlation with that. So when you start to see unemployment rise, that is when your market tends to kind of capitulate. And when unemployment is at all-time highs, that's when usually the stock market is at all-time lows. And we're currently at all-time lows still for unemployment. So in order for markets and this to be a sustained new bull rally, really, you need to see unemployment now topple. Is that likely in a recession? When we're already at these pretty historically low levels, we know there's low participation. and we're going into a recession where we're getting killed off by inflation and we're getting killed off by what is going to be a restrictive monetary policy. All things that you need to think about, things that I pay attention to. Yes, we know that markets are forward-looking and they're going, okay, well, peak hawkish is probably out the way. But until the kind of hens come home to roost, you know, we're not going to know exactly what's taking place. So inflation figures that the Fed follows closely hits highest level since January 1982. So I'm going to say that things are different this time. You should always never say that, but I would say they probably are. We've not seen this before, not even in the 2000s crash or the 2008 crash. This is why I could be totally wrong here, and this could be the new bull market. But I think the risk to reward of getting in here, the risk far outweighs the reward right now in terms of me turning around and becoming an investor. Again, we get this rally, I'll trade it long. You know, for me, crypto is a brilliant asset class because it moves to the up and the downside, which means from a trader's point of view, it gives me opportunities on a daily basis. Will the Bitcoin mining industry collapse? This is another thing talking. We've spoken about how miners, given the price of Bitcoin coming down, you know, they end up in a situation where they're probably not as profitable as they once were and become forced sellers. This was from Cross Border Capital. This guy's definitely worth a follow. Talking about bad earnings being the next catalyst for the next leg lower. Restating our view, this is why we have been bearish stocks, now bullish bonds. And predicting a recession, huge global liquidity squeeze, which still working through. The small pickup shows it will continue to fall by 10% annualized rate, but Fed pivot will come early 2023. So this is something that we're going to be looking at. When we see the Fed start to change their tune, which they've kind of somewhat done, but they're not pivoting in regards to starting to lower interest rates or you know, not hike anymore. That is a good sign for us to go, okay, well, they're going to start adding liquidity to the economy. They're going to start adding it to markets, and that's when we can get back in. These are all things you should be paying attention to, and if you aren't, you're going to get caught with your pants down. That's why this channel is here, because we don't just give you crypto analysis. We look at everything broadly. S&P 500 2023 EPS expectations falling off a cliff. So for me, again, the main thing is right now, if this is the new bull market coming in, hey, we'll admit that we didn't get this right. And that ultimately, you know, we'll have to get in at higher prices. But for me, the capital that I've got, I think is better served for now, sat where it is, than putting it back in from an investment thesis. We still have exposure to crypto in the forms of, you know, 20+%. But ultimately, you know, we're quite cash heavy because I still think that, again, the risk far outweighs the rewards of putting all my capital back into the markets right now. But that opportunity will come. You know, nobody's a bigger believer in this industry than I am. And ultimately, we will be there to capitalize off it, just like we were there to capitalize off the prior bull run. Caught a little bit of 2017, but of course I was new to the market, and that's where I learned a lot of my lessons. So that's all I've got for you in this video, guys. Stay tuned for that interview with Francis coming out some point this weekend, possibly Monday. My Patreon members are going to get that tonight, and I'll catch each and every one of you in the next YouTube video. Thanks a lot for watching, guys. See you in the next one.